Hey everyone, and welcome to your one-stop shop for all things ETFs versus mutual funds. Ever felt overwhelmed by these two investment options? You're not alone. Both can be powerful tools for building long-term wealth, but they cater to different styles. In this video, we'll break down the key differences between ETFs and mutual funds. We'll explore how they handle things like fees, diversification, taxes, and even your control over your investments. By the end, you'll be a confident investor, ready to choose the option that best fits your goals and risk tolerance. So buckle up, and get ready to unlock the mystery behind ETFs and mutual funds. What are the key characteristics of ETFs and mutual funds? ETFs, exchange-traded funds, and mutual funds are both popular investment vehicles used for building wealth. However, they have some key characteristics that differentiate them. Structure and trading. ETFs operate similarly to stocks. They trade on exchanges throughout the day at market price, which can fluctuate. Investors buy and sell shares on the exchange, just like any stock. Mutual funds don't trade on exchanges. Investors purchase shares directly from the fund company at the fund's net asset value, NAV, which is calculated only once per day at the close of the market. Management. ETFs, primarily passively managed, meaning they track a specific index, like the S&P 500, and aim to mirror its performance. They have lower fees due to this passive approach. Mutual funds can be actively or passively managed. Actively managed funds have portfolio managers who make investment decisions to outperform a benchmark. Passively managed mutual funds, like index funds, function similarly to ETFs but might have slightly higher fees due to additional overhead. Transparency. ETFs offer high transparency as their holdings are publicly disclosed daily. Investors know exactly what assets the ETF holds. Mutual funds disclose holdings only quarterly, offering less frequent transparency. Minimum investment. ETFs may have lower minimum investment amounts compared to some mutual funds, making them more accessible to smaller investors. Mutual funds often have minimum investment requirements, which can range from a few $100s to a higher initial investment. Tax efficiency. ETFs can be more tax efficient due to their in-kind creations and redemptions. This means when underlying assets are bought or sold within the fund, it may minimize capital gains distributions for investors. Mutual funds distribute capital gains when selling assets within the fund, which can trigger tax liabilities for investors even if they haven't sold their shares. Liquidity. ETFs, generally considered more liquid due to their exchange-traded nature. Investors can buy and sell shares throughout the trading day. Mutual funds, less liquid than ETFs. Investors can only buy or sell shares at the end of the trading day, based on the NAV. Investment focus. ETFs offer a broad range of investment options, including specific sectors, commodities, and international markets. Mutual funds, similar variety as ETFs, but may also offer specialized options not readily available in ETF form, such as actively managed thematic or niche funds. How do expense ratios differ between ETFs and mutual funds? Expense ratios play a crucial role in long-term investment returns, and they differ significantly between ETFs and mutual funds. Here's a breakdown. What is an expense ratio? The expense ratio is an annual fee expressed as a percentage of a fund's assets. It covers the costs associated with managing the fund, including management fees, paid to the portfolio manager, applicable to actively managed funds. Administrative fees, cover operational expenses like record-keeping, legal fees, and marketing. Distribution fees, costs associated with distributing dividends or capital gains to shareholders. ETFs versus mutual funds expense ratio showdown. ETFs generally boast lower expense ratios compared to actively managed mutual funds. This is because ETFs are passively managed, meaning they track an index and require less management oversight. Expense ratios for ETFs can be as low as 0.03%, making them very cost-effective. Mutual funds, expense ratios for mutual funds can vary widely depending on the type of fund. Actively managed mutual funds, with their human management component, typically have higher expense ratios ranging from 0.5% to 2% or more. Passively managed index funds within mutual funds can have expense ratios closer to those of ETFs, around 0.1% to 0.5%. Why the difference? Several factors contribute to the lower expense ratios of ETFs. Passive management, ETFs don't require a team of analysts actively researching and selecting investments, leading to lower management fees. Economies of scale, many ETFs track broad market indices, allowing them to spread their fixed costs over a larger asset base, resulting in lower fees per investor. ETF structure, the creation and redemption process of ETFs can be more tax efficient, reducing some administrative costs. Impact on investment returns. Expense ratios directly impact your investment returns. Lower expense ratios translate to higher returns over time due to the power of compounding. For example, a 1% difference in expense ratio over 20 years can significantly reduce your investment returns. What are the trading advantages and disadvantages of ETFs compared to mutual funds? When it comes to trading, ETFs and mutual funds offer distinct advantages and disadvantages. Here's a breakdown to help you decide which might be a better fit for your investment style. Advantages of ETFs. Intraday trading, ETFs trade throughout the day on exchanges just like stocks. This allows investors to react to market movements and potentially capitalize on short-term opportunities. You can place buy and sell orders at specific prices, offering more control over entry and exit points. Price transparency, ETFs have real-time market prices that fluctuate throughout the trading day. This allows for more precise valuation and potentially better execution of trades. Potential for tighter bid-ask spreads. Bid-ask spreads represent the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. ETFs, with their higher trading volume, often have tighter bid-ask spreads compared to some mutual funds, reducing transaction costs. Potential tax efficiency. The creation and redemption process of ETFs can be more tax efficient than mutual funds. When underlying assets are bought or sold within the ETF, it may minimize capital gains distributions for investors. This can be particularly advantageous for long-term investors who want to minimize their tax burden. Disadvantages of ETFs. Commissions. While some brokerages offer commission-free ETF trades, some may still charge commissions for each trade. Frequent trading with commissions can eat into your returns. ETFs are generally better suited for a buy-and-hold strategy rather than active trading due to potential commission costs. Market volatility. ETFs are subject to market fluctuations throughout the day. This can be advantageous for active traders, but may be unsettling for investors seeking a more stable investment. Limited order flexibility. While offering more control than mutual funds, ETFs may not allow for all types of orders, such as stop-loss orders or trailing stop orders, which can be used to manage risk. Advantages of mutual funds. No commissions. Mutual funds are typically purchased directly from the fund company, and many brokerages offer commission-free purchases. This can be beneficial for investors who don't plan on actively trading their holdings. Lower transaction costs. Without commissions and potentially wider bid-ask spreads, mutual funds can be a more cost-effective option for investors who plan to buy and hold for the long term. Potential for portfolio diversification. Mutual funds, particularly index funds, offer instant diversification across a basket of securities. This reduces portfolio risk compared to buying individual stocks. Greater order flexibility. Mutual funds allow for various order types, including stop-loss orders to automatically sell if the price falls below a certain level, which can help manage risk. Disadvantages of mutual funds. Limited trading flexibility. Mutual funds can only be bought or sold at the end of the trading day based on the NAV, net asset value. This limits your ability to react to market movements or take advantage of short-term opportunities. Less price transparency. Since the NAV is only calculated once daily, you don't have real-time pricing information and may not know the exact price you'll pay or receive until the trade settles. Potential for higher tax drag. Actively managed mutual funds that frequently buy and sell securities may generate more capital gains distributions for investors, leading to potential tax liabilities even if they haven't sold their shares. Choosing between them. The best choice depends on your investment goals and trading style. Active traders, ETFs with their intraday trading and potentially tighter spreads might be a better fit. However, consider commission costs if you plan on frequent trading. Long-term investors, mutual funds can be a cost-effective option, especially with commission-free purchases. Tax-conscious investors, ETFs with their potential for tax efficiency might be preferable, particularly for long-term investing. How do ETFs and mutual funds handle tracking errors? Tracking error refers to the difference between the performance of an index fund, ETF or mutual fund, and the benchmark index it tracks. Here's a breakdown of how ETFs and mutual funds handle tracking errors, highlighting their strengths and weaknesses. ETFs. Tracking method. Since ETFs trade on exchanges throughout the day, they aim to replicate their target index by continuously buying and selling underlying assets to match the index composition. This process is called in-kind creation and redemption. Challenges. Transaction costs. Buying and selling securities to mirror the index incurs transaction costs, commissions, bid-ask spreads, that can cause the ETF's return to deviate from the index return. These costs eat into the ETF's returns, contributing to tracking error. Market liquidity. If the underlying assets in the index are not highly liquid, easily tradable, it can be challenging for the ETF to buy or sell them efficiently. This can lead to tracking errors, especially for ETFs tracking less liquid markets or niche sectors. Tracking differences. Due to the continuous buying and selling throughout the day, the ETF's price might not perfectly reflect the NAV, net asset value, based on the underlying holdings. This difference can contribute to tracking error. Mutual funds. Tracking method. Mutual funds typically track their benchmark index less frequently than ETFs. They rebalance their portfolio periodically, daily, weekly, or monthly, to align with the index composition. This rebalancing involves buying or selling underlying assets to match the target weights of the index. Challenges. Timing risk. Rebalancing only occurs at specific intervals, which can lead to tracking errors. If the market moves significantly between rebalancing periods, the mutual fund's performance may deviate from the index. Cash drag. During rebalancing, the mutual fund might hold some cash while waiting to buy or sell assets. This cash holding doesn't generate returns like the underlying securities, contributing to tracking error. Expense ratio. Expense ratios, which cover management and operational fees, can also contribute to tracking error. Higher expense ratios lead to a larger gap between the mutual fund's return and the index return. Strategies to minimize tracking error. Efficient sampling. Some ETFs use statistical sampling techniques to track a representative subset of the index, potentially reducing transaction costs and improving tracking efficiency. Optimization techniques. Fund managers may employ optimization techniques to minimize transaction costs and cash drag during rebalancing for mutual funds. Lower expense ratios. Choosing ETFs and mutual funds with lower expense ratios can help minimize the drag on performance and improve tracking efficiency. When might an investor choose an ETF over a mutual fund for long-term wealth building? Several factors can make ETFs a compelling choice for long-term wealth building compared to mutual funds. Here's a breakdown of scenarios where ETFs might shine. Tax efficiency. Lower capital gains distributions. ETFs generally experience fewer capital gains distributions compared to actively managed mutual funds. This is because they passively track an index and don't frequently buy and sell securities within the fund. Less frequent capital gains distributions translate to potentially lower tax liabilities for investors, particularly for those in tax-advantaged accounts. Cost effectiveness. Lower expense ratios. Passively managed ETFs typically boast lower expense ratios compared to actively managed mutual funds. Lower expense ratios mean more of your investment returns are retained and compounded over time, leading to greater long-term wealth accumulation. Transparency and control. Real-time pricing. Unlike mutual funds with a single NAV, net asset value, calculated daily, ETFs trade throughout the day with real-time market prices. This allows for more precise valuation and potentially better control over entry and exit points when buying or selling shares for your long-term investment strategy. Trading flexibility. For some, intraday trading, while not necessarily crucial for long-term investing, some investors may appreciate the ability to react to market movements with ETFs. ETFs trade on exchanges like stocks, allowing for intraday buying and selling if desired. However, frequent trading can erode returns due to commissions, so weigh the benefits against the costs. Diversification. Broad market exposure. Many ETFs track broad market indices like the S&P 500, offering instant diversification across a basket of securities. This reduces portfolio risk compared to picking individual stocks, which can be particularly beneficial for long-term wealth building through a diversified approach. Specific investment goals. Niche or sector exposure. While less common, some ETFs track specific sectors, commodities, or international markets. This allows investors to target specific areas for their long-term wealth building goals, potentially offering a more focused approach than some actively managed mutual funds. Conversely, in what scenarios might a mutual fund be preferable to an ETF for long-term investing? While ETFs offer several advantages for long-term wealth building, there are situations where mutual funds might be a better fit. Here's a breakdown of scenarios where mutual funds can excel for long-term investors. Lower transaction costs. Commission-free purchases. Many brokerages offer commission-free purchases of mutual funds, especially for index funds. This can be advantageous for long-term investors who plan to buy and hold for the long term, avoiding commission costs that can erode returns, particularly with smaller investments. While some ETFs are also commission-free, it's not universally applicable. Greater investment flexibility. Stop-loss orders. Mutual funds allow for various order types, including stop-loss orders. These orders automatically sell your shares if the price falls below a certain level, helping to manage downside risk in a long-term investment strategy. While some ETFs may offer limited order flexibility. Professional management. For some actively managed strategies, If you prefer a more hands-off approach and are comfortable with higher expense ratios, actively managed mutual funds can offer the expertise of portfolio managers who aim to outperform the market. This approach can be beneficial in specific market conditions or for investors seeking a more targeted strategy. However, actively managed funds don't always outperform the market, and past performance is not indicative of future results. Specific investment goals. Unique investment options. Mutual funds offer a wider variety of investment options compared to ETFs. This includes niche funds targeting specific sectors, strategies, or bond categories. These options can be useful for investors seeking a more tailored approach to their long-term wealth-building goals. While some niche ETFs are emerging, they may be less readily available. Tax-advantaged accounts. Reduced tax impact. Since capital gains taxes are typically deferred in tax-advantaged accounts like IRAs or 401(k)s, the potential tax efficiency benefits of ETFs are less impactful. In these cases, the lower expense ratios and investment flexibility offered by some mutual funds can be more appealing for long-term wealth accumulation. However, mutual funds also have some drawbacks. Limited trading flexibility. Mutual funds can only be bought or sold at the end of the trading day based on the NAV, net asset value. This limits your ability to react to market movements or take advantage of short-term opportunities, which might be irrelevant for a long-term investor but is a consideration. Less price transparency. Since the NAV is only calculated once daily, you don't have real-time pricing information and may not know the exact price you'll pay or receive until the trade settles. Potential for higher expense ratios. Actively managed mutual funds often have higher expense ratios compared to passively managed ETFs. These higher fees can eat into your long-term returns. How does liquidity impact investing in ETFs versus mutual funds? Liquidity refers to the ease with which an investment can be bought or sold at a fair price. Here's a breakdown of how liquidity impacts investing in ETFs compared to mutual funds, highlighting the advantages and disadvantages for each. ETFs. Advantages. High liquidity. ETFs trade throughout the day on exchanges just like stocks. This allows investors to enter and exit positions quickly and easily, with potentially tighter bid-ask spreads compared to some mutual funds. This high liquidity can be particularly beneficial for investors who need to access their cash quickly or want to react to market movements. Creation and redemption process. The creation and redemption process of ETFs can further enhance liquidity. Authorized participants, large institutions, can create new ETF shares by delivering a basket of underlying assets to the fund company. Conversely, they can redeem existing shares for the underlying assets. This process helps ensure a sufficient supply of ETF shares to meet investor demand. Disadvantages. Underlying asset liquidity. While the ETF itself might be highly liquid, the underlying assets it holds may not be. This can be a concern for ETFs tracking less liquid markets or niche sectors. If the underlying assets are difficult to buy or sell, it can impact the ETF's ability to efficiently track its target index. Mutual funds. Advantages. No bid-ask spread. Mutual funds don't have bid-ask spreads like ETFs. Investors purchase shares directly from the fund company at the NAV, net asset value, calculated at the close of the trading day. This eliminates the potential for price discrepancies between buyers and sellers. Disadvantages. Limited trading flexibility. Mutual funds can only be bought or sold at the end of the trading day based on the NAV. This limits your ability to react to market movements or take advantage of short-term opportunities. If the market price moves significantly between the time you place your order and the NAV calculation, you could end up paying more or receiving less than anticipated. Potential for illiquidity. If a mutual fund invests in less liquid assets, it might face redemption pressures during market downturns. When a large number of investors want to sell their shares simultaneously, the fund may not have enough cash readily available to meet all redemption requests. This could lead to delays or even suspensions of redemptions, impacting your ability to access your money. Impact on long-term investing. Liquidity is generally less crucial for long-term investors who plan to hold their investments for several years or decades. They are less concerned with short-term price fluctuations or the need to access their cash quickly. However, liquidity can still be a factor to consider. For example, if you anticipate needing access to your money during a market downturn, an ETF with high liquidity might be a better choice than a less liquid mutual fund. Does diversification potential differ between ETFs and mutual funds? No, the diversification potential between ETFs and mutual funds is generally quite similar. Both offer a way to achieve diversification across a variety of asset classes and sectors, which is a crucial principle for long-term wealth building. Here's a breakdown of how they achieve diversification. Diversification strategies. Index tracking. Both ETFs and mutual funds can track broad market indices like the S&P 500 or other sector-specific indices. By holding a basket of securities within the index, investors gain exposure to a variety of companies, reducing their reliance on the performance of any single stock. Actively managed options. Both actively managed ETFs and mutual funds exist. These funds invest in a basket of securities chosen by a portfolio manager, aiming to outperform a benchmark index. While not guaranteed to outperform, this approach can offer diversification across holdings selected by the manager's expertise. Target date funds. Both ETFs and mutual funds offer target date funds, which automatically adjust their asset allocation based on an investor's target retirement date. This provides diversification across asset classes with adjustments over time to manage risk as the investor nears retirement. How do rebalancing strategies factor into choosing between ETFs and mutual funds? Rebalancing is a crucial aspect of maintaining a diversified portfolio for long-term wealth building. Here's a breakdown of how rebalancing strategies factor into choosing between ETFs and mutual funds. Rebalancing explained. Over time, the market performance of different asset classes within your portfolio can cause the weightings of those assets to drift away from your target allocation. Rebalancing involves buying or selling assets to bring your portfolio back to its original target asset allocation. This helps maintain diversification and manage risk. Rebalancing strategies with ETFs versus mutual funds. Trading frequency. ETFs. Since ETFs trade throughout the day, investors have more flexibility to rebalance their portfolios more frequently. They can react to market movements and adjust their holdings as needed, potentially leading to more precise rebalancing. However, frequent trading of ETFs can incur commission costs, which can erode returns. Mutual funds. Mutual funds can only be bought or sold at the end of the trading day based on the NAV, net asset value. This limits your ability to rebalance as frequently as with ETFs. However, there are no commission costs associated with buying or selling mutual funds, though some brokerages may charge account fees. Tax implications. ETFs. Frequent rebalancing of ETFs can trigger capital gains events, especially if the underlying assets within the ETF are being bought and sold. This can have tax implications for investors, particularly in taxable accounts. Mutual funds. Since rebalancing of mutual funds happens within the fund itself, not directly by the investor, there are generally no immediate tax implications for investors unless they choose to sell their shares in the mutual fund. Control and automation. ETFs. Investors have more control over the rebalancing process with ETFs due to their intraday trading nature. They can choose the specific price points for buying or selling shares. However, this requires more active management on the investor's part. Mutual funds. Some mutual funds offer automatic rebalancing features that will adjust the portfolio allocation periodically based on predefined parameters. This can be a convenient option for investors who prefer a hands-off approach. However, investors relinquish some control over the specific timing and price points of rebalancing. How do international investment opportunities differ between ETFs and mutual funds? International investment opportunities can be a valuable way to diversify your portfolio and potentially enhance long-term returns. Here's a breakdown of how ETFs and mutual funds differ when it comes to accessing international markets. Similarities. Broad exposure. Both ETFs and mutual funds offer a variety of options for international investment. You can find funds focused on specific countries, regions, or emerging markets. Reduced risk. International diversification can help reduce portfolio risk by spreading your investments across different economies and currencies. This can help mitigate the impact of fluctuations in any single market. Differences in international investments. Transparency. ETFs generally offer less transparency regarding their specific holdings compared to mutual funds. Since ETFs trade throughout the day, the underlying holdings might not be disclosed as frequently as with mutual funds. Mutual funds often disclose their holdings quarterly, providing a clearer picture of the specific companies and countries you're invested in within the international fund. Trading efficiency. ETFs may offer greater trading efficiency for international investments due to their exchange-traded nature. This can be beneficial for investors who want to react to market movements or take advantage of short-term opportunities. Mutual funds can have wider bid-ask spreads for international investments compared to domestic funds. This can slightly increase transaction costs for investors, especially for less liquid international markets. Minimum investment. ETFs may have lower minimum investment requirements compared to some international mutual funds. This can be advantageous for investors starting with smaller amounts. Mutual funds. Some international mutual funds, particularly those targeting specific emerging markets, might have higher minimum investment requirements. Management fees. ETFs often have lower management fees compared to actively managed international mutual funds. This can be particularly true for broad market international index ETFs. Mutual funds. Actively managed international mutual funds with specific regional or country focus may have higher management fees due to the additional research and analysis involved. How do control and portfolio selection differ between actively managed mutual funds and ETFs? Control and portfolio selection differ significantly between actively managed mutual funds and ETFs, impacting your investment experience. Here's a breakdown. Control. Actively managed mutual funds. Limited control. Investors have limited control over the specific holdings within the fund. The portfolio manager makes investment decisions based on their research and analysis. Active management. Investors are relying on the expertise of the portfolio manager to outperform the market and generate returns. This approach can be appealing to those who prefer a hands-off approach or lack the time and knowledge to manage their own portfolio. ETFs. Greater control. For underlying holdings, while some ETFs offer actively managed strategies, most are passively managed and track a specific index. This gives investors more control in a sense, as the underlying holdings are typically predetermined by the index composition. Trading flexibility. ETFs trade throughout the day, allowing investors to choose their entry and exit points, potentially offering more control over their investment timing. However, this requires active management on the part of the investor. Portfolio selection. Actively managed mutual funds. Unique strategies. These funds offer a wider variety of investment styles and strategies. You can find funds focused on specific sectors, value investing, growth investing, or socially responsible investing, SRI. This allows for a more tailored approach to portfolio selection based on your investment goals and risk tolerance. Manager research. Choosing an actively managed mutual fund involves researching the fund's past performance, the portfolio manager's track record, and the investment philosophy they employ. ETFs. Index-based selection. The majority of ETFs track a specific index, so the portfolio selection is essentially predetermined. This can be a benefit for investors who prefer a diversified approach based on a well-established index. Limited customization. While some niche ETFs targeting specific sectors or strategies are emerging, they generally offer less customization compared to actively managed mutual funds. Choosing between them. The best choice depends on your investment preferences. Hands-off approach. If you prefer a hands-off approach and trust the expertise of a portfolio manager, actively managed mutual funds can be a good option. However, keep in mind that past performance is not indicative of future results. Active investor. If you enjoy researching and making investment decisions, passively managed ETFs might be a better fit. They offer transparency into the holdings and allow for more control over timing through intraday trading, though frequent trading can incur costs. Investment goals. Consider your overall investment goals and risk tolerance. Actively managed mutual funds might be suitable for specific investment strategies, while ETFs can offer a diversified, low-maintenance approach. Additional considerations. Expense ratios. Actively managed mutual funds typically have higher expense ratios compared to passively managed ETFs due to the management fees involved. Consider the impact of fees on your long-term returns. Tax implications. Both actively managed mutual funds and ETFs can have tax implications, particularly for those held in taxable accounts. Are there any specific investment goals better suited to ETFs or mutual funds for long-term wealth accumulation? Yes, there are certain investment goals that might be better suited to ETFs or mutual funds for long-term wealth accumulation. Here's a breakdown of how their characteristics can align with specific goals. Investment goals more aligned with ETFs. Low cost, broad market diversification. ETFs, particularly passively managed index ETFs, generally boast lower expense ratios compared to actively managed mutual funds. This translates to potentially higher long-term returns for investors focused on broad market exposure and wealth accumulation through a buy-and-hold strategy. Tax-efficient long-term growth. ETFs experience fewer capital gains distributions compared to actively managed mutual funds. This can be beneficial for investors in taxable accounts, as they defer paying capital gains taxes until they sell their shares. This allows for reinvesting those gains and potentially accelerating long-term wealth accumulation. Targeted sector or niche exposure. While less common than broad market ETFs, there are a growing number of niche ETFs targeting specific sectors, commodities, or even thematic strategies. This allows investors to focus on specific areas for long-term growth aligned with their investment goals. Flexibility with entry and exit points. For some ETFs trade throughout the day, offering some flexibility for investors who want to react to market movements or time their entry and exit points within a long-term strategy. However, frequent trading can erode returns due to commissions. Investment goals more aligned with mutual funds. Specific investment strategies. Actively managed mutual funds offer a wider variety of investment styles and strategies beyond just broad market exposure. Investors seeking value investing, growth investing, or specific sector focus might find suitable options among actively managed mutual funds to complement their long-term wealth-building goals. Lower minimum investment requirements. For some mutual funds, especially index funds, may have lower minimum investment requirements compared to certain ETFs. This can be beneficial for investors starting small and gradually building their wealth over the long term. Automatic rebalancing features. For some mutual funds offer automatic rebalancing features, which can be helpful for investors who prefer a hands-off approach to maintaining their target asset allocation within their portfolio for long-term wealth building. How do factors like market volatility impact the decision between ETFs and mutual funds for long-term investing? Market volatility can significantly impact the decision between ETFs and mutual funds for long-term investing. Here's a breakdown of how each reacts to volatile markets and how it affects your long-term investment strategy. Impact of market volatility on ETFs. Potential advantages. Intraday trading. ETFs trade throughout the day, allowing investors to potentially react to volatile markets by buying or selling shares at specific price points within their long-term strategy. This can be beneficial for skilled investors who can time the market effectively. However, frequent trading incurs commissions that can erode returns. Transparency. Limited transparency regarding the underlying holdings within an ETF can be a disadvantage in volatile markets. However, some investors might find the overall index tracking of passively managed ETFs reassuring during periods of uncertainty. Potential disadvantages. Tracking error amplification. During volatile markets, the bid-ask spread of the underlying assets within an ETF can widen. This can make it more challenging for the ETF to perfectly track its target index, potentially leading to a larger tracking error and impacting long-term returns. Liquidity concerns. If the underlying assets in an ETF are not highly liquid, it can be difficult for the ETF to efficiently buy or sell them during volatile markets. This can impact the ETF's ability to track the index and might affect your entry or exit points. Impact of market volatility on mutual funds. Potential advantages. Lower transaction costs. Mutual funds don't have commission costs associated with buying or selling. This can be advantageous during volatile markets, as frequent trading to react to price movements might be less cost-effective with ETFs. No bid-ask spread. Investors purchase shares directly from the fund company at the NAV, net asset value, calculated at the close of the trading day. This eliminates potential discrepancies between buying and selling prices during volatile markets. Potential disadvantages. Limited trading flexibility. Mutual funds can only be bought or sold at the end of the trading day. This limits your ability to react to short-term market movements or take advantage of sudden price changes within a volatile market. Potential delays and redemptions. During periods of extreme market volatility and high redemption pressures, there's a slight chance that a mutual fund might experience delays or even suspensions in redemptions. This could limit your ability to access your cash if needed. Alright everyone, that's all the time we have for today's deep dive into ETFs versus mutual funds. Remember, there's no single best option. The perfect choice depends on your investment goals, risk tolerance, and even your preferred level of control. No matter which path you choose, ETFs and mutual funds can be powerful allies in your long-term wealth-building journey. For additional resources, check out the links in the description below. And if you have any questions, leave them down in the comments, and I'll be happy to help. Thanks for watching, and happy investing!